Hello, my name's Sarah Wheeler, and I'm the head of the Anti-Money Laundering Division at the Cayman Islands Monetary Authority, and today I'm going to give a short presentation on our recent sectoral risk assessment we made of the mutual funds administration sector. So I'm going to cover a number of aspects of the work we've been doing in this area. First of all, I'll talk a little bit about the background and overview to this risk assessment, and then I'll briefly describe the methodology that was used. Then we'll move to a short description of the mutual funds administrator, or the MFA sector, and then go on to look in more detail at the specific risk categories for that sector. And here we're looking at the inherent risks, so nature, size and complexity, geographical risks, types of customers, transactions, products and services, delivery channels. Then we'll finally move on to our summary and conclusions, including the overall risk rating. And finally, we'll look at some of the key takeaways for our licensees in terms of how they can use these findings to enhance and make more effective their risk-based approach to managing and mitigating AML-CFT risk. So the background and purpose to this risk assessment really has three elements. It's first at national level to enhance our understanding in the Cayman Islands and inform and assist our policy making and supervision for this sector in terms of AML and CFT. And at supervisory level, it allows us to allocate our resources effectively and efficiently. And most important to those listening to this presentation is at a sectorial level, it enables MFAs to really identify, assess and understand the money laundering terrorist financing risks faced by them and align all aspects of their internal controls and procedures with that risk understanding. So a number of data sets were used to form this risk assessment. These include the National Risk Assessment conducted by the Cayman Islands as a whole, our internal guidance documents, annual AML-CFT reporting data from MFAs, and I know that information requests were sent out and we had some very granular submissions, so a huge pool of data to draw from. Supervisory judgment and expertise by CIMA staff, discussions with industry representatives and consultants, very important, and of course the various guidance documents that have been issued by CIMA. So what was the methodology behind this risk assessment in broad terms? Predominantly, this looks at the inherent money laundering terrorist financing risks faced by MFAs. This approach allows for the creation of peer groups and for benchmarking of expected controls. It doesn't take into account mitigating factors such as systems and controls. It really just focuses on the inherent risk factors, which include the nature, size and complexity of the sector, types of customers, transactions, products and services and delivery channels, and geographic factors which actually underpin all four of those elements. And for each risk category, there were examples of risk increasing and decreasing factors. And the risk factors were expressed on a sliding scale from low through medium low, medium high to high. So what does the MFA sector look like in the Cayman Islands? Well, as at November 2019, there were 80 regulated MFAs categorised as such. MFAs with full licences, 69, MFAs with restricted licences, 10, and MFAs exempted licences, 1. CIMA conducted a survey in December 2019 and obtained responses from 81% of licensed MFAs. This data helped us arrive at our overall assessment of a medium-high risk rating for this sector. Interestingly, this rating is consistent with the rating that was given in 2017, where MFAs were considered as part of an overall risk assessment for the security sector. So this slide shows a summary of those findings per inherent risk factor. So nature and size, medium high, geographic risk, medium low, customers, medium low, transactions, products and services, medium high, delivery channels, medium high, and the overall risk rating being medium high. And I'll go into describe the methodology behind each of those categories. So let's look in a bit more detail at the nature, size and complexity of the MFA sector. So services provided to investment funds include processing subscriptions and redemptions, undertaking client due diligence, ensuring compliance with anti-money laundering procedures, and also the traditional MFA services of registrar and transfer agency, net asset value calculations, principal office and registered office services. MFAs can include small single offices, and they can include global operations. So from the MFAs that we surveyed, they reported that total assets under administration were over $2 trillion US. The total number of funds under administration was 16,000, of which 62% were unregulated, and the total number of investors was 169,000, 54% of which were associated with unregulated funds. Now this graph shows a breakdown of the parent companies of those MFAs, which, as you can see, are located in various jurisdictions across the world. The majority is in the Cayman Islands, 29% have a parent company in the Cayman Islands. And then significantly lower, almost half of that, parent companies are located in the United States. Decreasing again almost by half, the next parent companies are located either in the UK and Ireland. And then we see Japan, Canada, Luxembourg, and another high proportion of non-risk countries as being the locations of parent companies, with only 3% of parent companies being located in high-risk jurisdictions. And this chart shows the location of shareholders for MFAs, and as we can see, there is quite an even split across a number of jurisdictions. By far the greatest is the Cayman Islands. However, none of those jurisdictions are high-risk jurisdictions, and indeed the proportion of shareholders located in high-risk jurisdictions is less than 10%. So the overall risk assessment for the nature, size and complexity of MFA sector was medium-high. That took into account the risks associated with the high value of assets under administration and the fact that services are provided to unregulated funds, although it could be argued the involvement of a regulated MFA goes some way to mitigate that risk. It was also taken into account that actually 85% of parent companies, subsidiaries and affiliates are in countries with equivalent AML CFT frameworks. So taking all those factors together, the overall risk was deemed medium-high. Taking a quick look at where funds are regulated, all of the regulated funds are Cayman Islands regulated funds. And of the unregulated funds, 77.9% are incorporated in the Cayman Islands. The rest of the sizable chunk is mostly incorporated in the United States, 16.5%, and 5.4% are in other non-high-risk countries with equivalent AML CFT legislation. So when we looked at the data for regulated and unregulated funds, it was clear that the vast majority, 57%, of investors came from the United States, with the rest of the investors coming from the Cayman Islands, Switzerland, UK and Ireland, Canada and Luxembourg. None of these countries are considered high risk. So having considered all of those factors, the overall risk rating for geographic risk was considered medium-low. This took into account that unregulated funds are mostly incorporated either in the Cayman Islands or in a country with an equivalent AML CFT framework, and this was the same for investors. Where core services were outsourced, this was also mostly to countries with equivalent AML CFT frameworks, and as a result that rating was deemed medium-low. So the next aspect of considering inherent risk is to look at the types of customers, and the customers can include both the funds and the investors. So looking at the structure of funds, 55% of them are Cayman incorporated companies and 12% are partnerships. And of those, 13% are US incorporated companies and partnerships. The legal structures for investors into the funds is that 72% are companies, and that does represent 77% of assets under administration. 22% are partnerships, with 19% of assets under administration, so the biggest chunk are companies, representing by far the biggest proportion of assets under administration. And the data showed that there were several different types of investors that we found. 29% were body corporates, 22% were individuals other than high net worth individuals, 12% were high net worth individuals, 9% were nominee shareholders, and 9% were trusts. And breaking down those statistics further in these graphs, you can see how that those numbers translate into risk categories. So for body corporates, 27% were what we would describe as high risk types of customers, 31% medium risk, 28% low risk. And again, for the individual customers, we've broken it down to those that would be considered high risk, medium risk and low risk. And again, these charts show that risk rating by type of customer for high net worth individuals, nominee shareholders and trusts. So the conclusion from looking at the types of customers was that taking into account the majority of funds are located in low risk jurisdictions, and that more than 50% of all customers are either body corporates or individuals other than high net worth individuals and PEPs, and the fact that of those high net worth individuals and PEPs, 91% of them are associated with low risk countries, the overall risk rating for customer risk was deemed medium-low. So looking now at transactions, products and services. The data we collected between 1st of July and 30th of June 2019 indicated a huge volume of transactions in the market. So $350 billion in subscription, $328 billion in redemptions, $63 billion in transfers, and $9 billion of subscriptions and $42 billion in redemptions, 13% of which were with PEPs. The majority of those transactions originated with the Cayman Islands, the USA, and Japan. So taking a look now at the services that are provided by MFAs, these include the Register and Transfer Agent Services, RTA services, the Net Asset Valuation Calculation Services, Directorship Services, Registered Office, Principal Office and Tax Reporting, and some other services. It was deemed that the RTA services do expose the MFAs to higher money laundering, terrorist financing risks because these are the frontline services for vetting investors in and out of the funds. 74% of the MFAs by whom we collected data said that they provided RTA services. A further 71% provide NAV services and 30% directorships. So 73% in fact provide a combination of both RTA and NAV services. Another factor to consider when looking at the transactions, products and services inherent risk is where services may be offered to unregulated entities, as this could increase vulnerability. So 70% of RTA services are offered to unregulated entities, 68% of NAV services, 61% of directorships, and 87% of registered office services. So taking into account all of those factors and the size of the sector, the overall risk rating was deemed medium-high. So the final inherent risk category we will now consider is delivery channels. Now, delivery channels generally include face-to-face and non-face-to-face customer interaction. So face-to-face can include direct contact or through nominee investors, and non-face-to-face includes use of service providers or eligible introducers. 24% of the MFAs that gave us information use face-to-face customer onboarding, 49% use non-face-to-face, and a further 28% didn't indicate which method. So looking more closely at the non-face-to-face customer onboarding, 53% of those either accepted the customer directly but used other non-face-to-face methods, such as virtual technology video conferencing, or used nominees. 19% of MFAs also use eligible introducers. Of those eligible introducers located and regulated abroad, 10% are located in the USA. And this customer delivery channel was below 10% for all other countries, so widespread. However, it is important to emphasize that 75% of respondents did not identify the country of investors. So given this spread and the fact that we had a gap in information here, the overall risk rating for this inherent risk of delivery channels was considered medium-high. So at this point we can pause and reflect on all those mini-summaries and come to our overall summary and conclusion. So this data and this risk assessment leads us to conclude that there is an overall composite medium-high risk for this subsector. So risks emanating from types of customers and geographic risks were medium-low, but nature, size, complexity of the sector, transactions, products and services and distribution channels were considered medium-high. So what are the key takeaways for licensees from the findings of this risk assessment? Well, entities should consider all the conclusions and findings and really how you can implement that into your own institutional money laundering, terrorist financing risk assessments, including your customer risk assessments, and the measures that you can then take to manage and mitigate those risks further. So think about your risk identification and assessment, remembering that non-face-to-face onboarding and incomplete data can increase the risk of money laundering and terrorist financing. Consider the high value of the assets under administration and the percentage of unregulated funds. Think about which risk categories can be considered into your risk-based approach. And remembering that the inherent risk score will drive your risk management and mitigation. And always remain vigilant regarding customers, investors, or introducers from countries with weak or insufficient AML-CFT systems. So this shows the 4 stages of an effective risk-based approach to managing and mitigating money laundering and terrorist financing risk. So the first key aspect is to identify and assess those risks, and that's where this risk assessment can be very useful to help you do that. Then you can consider what appropriate measures you can put into place to manage and mitigate those risks. So that's where you may choose between your client due diligence or enhanced due diligence. That's where you may have transaction limits or dealing limits for certain clients. That's where you may have senior management sign off for certain actions or procedures. And of course, all of that may be implemented into your ongoing monitoring, which is going to be looking constantly at updating those risks connected with geographic risks, sanction screenings, other changes in your customer's profile. And finally, it's really key that all of the above and all of your updated risk assessments and reviews are documented, including your strategies, policies and procedures, so that external parties like the authority can understand and see how you are applying your risk-based approach. This risk assessment was based on a number of data sources, but there are further references and places you can go to find out more. There is, of course, the Basel AML Index and the UN sanctions list, which should be going into your ongoing monitoring programs, FATF recommendations, FATF national money laundering and terrorist financing risk assessments. There's also AMLRs in the Cayman Islands, which set out the legislative framework within which you must operate. And CIMA has produced a couple of guidance notes on ongoing monitoring and assessing risks and applying a risk-based approach, which you may also find useful. Finally, we have combined sectoral risk ratings published by CIMA and our AML-CFT newsletters and advisories published by CIMA. Thank you very much for listening. To the extent that you have any further questions, please do not hesitate to contact us here at the authority at contact@amlcft@cima.ky.